Maybe we just go around to our panelists to introduce ourselves. I'll start moderating. I'm Arcie Propster with Partner Engineering and Science. If you don't know what we do the environmental, the engineering, seismic, Alta surveys, and zoning and appraisals. All the fun things you need when you're going to get a loan or purchase a property or refi. And I will go over to Gina. How about Gina? Introduce yourself.
We are doing well. I'm sorry, I got a little distracted. I got a deal about to close and I was lost focus. But I am Gina with Provident Bank. Provident Bank is going on 70 years old. We are a large, small bank in California. We lend primarily, we love apartments all day long. We're doing small retail strip centers. We do like office. I'm looking at some office right now, actually in Bakersfield as well as Victorville, which is, kind of a highlighted more rural area where some lenders just don't like those areas. And then we are doing single family owner occupied construction right now. We're limited to that small bucket for construction, but we are getting some deals going in that arena. And I've been with the bank going on 18 years, so it's been a long time. And welcome everybody.
Yeah, Fred.
Thank you, Arcie. Fred Ornelas, Axos Bank. I've been with Axos Income Property Lending for 15 years. Axos Bank is a digital bank, neobank, primarily a digital bank. So we have no physical branch network. We finance pretty much anything investment real estate related. So it could be a single family, it could be 2 to 4 unit, mixed use, multifamily 5+, and then you also have all the major food groups of commercial, office, retail, light industrial, warehouse. We'll also dabble in hospitality as well as finance mobile home parks. We are known to do deals a little outside of your typical credit box. Credit box being about, for your typical credit box, be about this size, right? Our credit box is something like this size here. So much larger, and we're known to do deals that have a little hair on them. So what does that mean? It means that if you have a deal that needs projections, Axos Bank is able to project rents. We're able to project deals where there's no income, no income being generated from the property. So it could be a bridge to stabilization or a bridge to sale. And usually I see new builds, and we do a lot of those. We also work with borrowers that have credit-related issues. It could be a forbearance, foreclosure, short sale, bankruptcy, just generally overall a low FICO score. So we are not the lowest rate in the market. I would say you're about 75 basis points above the very best pricing. So all-in rate, you're looking in the high sixes, low sevens. Typically, that's where our coupon comes in at. But we are staying busy. We're a nationwide lender. Our minimum loan size is $500,000 on up to $275 million. So we also do the much larger loans as well. And that pretty much summarizes it.
Amazing. Right. Hi, Lindsay.
You guys today.
Great.
My name is Lindsay Spjut, and I'm a loan production officer with EverBank, and we specialize in financing multifamily properties. We're very competitive on rate. We offer low cost, and we have a transparent and streamlined process. As far as our focus, we're looking at loan amounts between 1 and 20+ million. We can accommodate purchase, refi, and cash out refinance requests, typically in the major metro markets of California, the Portland market, as well as the Seattle market. So excited to be here with all of you today and look forward to hearing from all of you as well.
Yeah. All right, AJ, you're up.
Hey, everybody. AJ Bolino, Regions Real Estate Capital Markets. We are a nationwide multifamily lender. We lend via Fannie Mae small balance, Fannie Mae conventional, Freddie Mac SBL, and Freddie Mac conventional buckets. Loan amounts run in the from a minimum of $1 million to about 9 million for small balance, and loans in excess of 9 million will be run through our conventional program. As it pertains to asset, we work on primarily workforce housing. That's really where the agencies tend to shine. So if you're looking at 2-3 star multifamily assets, those are really in our wheelhouse. We can also finance manufactured housing communities that are 3-star or better. And via Fannie Mae on the conventional side and via Freddie Mac on the conventional side, we can work on deed restricted affordable housing, LIHTC deals, tax abatement type structures. Those are all the types of deals that we can entertain. And at the end of the day, the one thing that I want to stress about our product and what we do, our credit box may not be massive, and we may not like deals that haven't shaved in a while, like Fred. However, one of the things that we can do is deals in every single market in the United States. The most unfindable places in this country, I can do a loan for you. The most unfindable place in America that I have done a loan is a place called Moss Point, Mississippi, that is right along the Gulf Coast. And we closed that loan with Fannie Mae a week before a hurricane hit. So the thing that I want to just ensure you, if you have a multifamily property, odds are I can do it. If your rents are relatively affordable, odds are I've got the best rate in the market. And if you have questions about process, timing, etc., I look forward to answering them. AJ Bolino, Regions Real Estate Capital Markets.
And last but not least, Valerie, you're up.
Can you hear me?
Sure can.
Yes.
Hi, guys. Valerie Hapner, VP of Origination at Forbix Financial. I have been at Forbix for 12 years and in the lending world for about 18 total. So I still do residential, but commercial is still my day-to-day grind. So anyway, thank you everyone for hopping on to the Zoom. We don't do this often, but Forbix is a nationwide lender for multifamily. I think everybody is multifamily. The only difference here is that we're a HUD lender. I think we're the only HUD lender on the panel. And that offers terms of 35 and 40-year fixes, and it's a non-recourse loan. The rates are in the fives. So we're seeing a lot of ground up construction, but mostly we're liking the takeout loans for HUD, 35-year fixed rates in the low fives. I've been giving out term sheets for that. It just longer timelines with HUD as usual. But yeah, it's not 2021 anymore. So if your deal has a real plan, real equity, and a path forward, and we can get creative just as long as they're real sponsors that have equity in the deal. We've got 2 debt funds now, bridge loans, and we're funding all major food groups, so multifamily, industrial, retail, office, up to 70% LTV. And we don't really have a minimum bucket, but I'll say, let's say 500 to 25 million, and we could move fast. So, we're investors ourselves as far as developers too. If you look at our website, we own maybe over 1,200 units. And so we wear all hats. And so we see it from your viewpoint or your clients or yours. So essentially can advise you on, how to not make the same mistakes we did, because we've been in the industry for a very long time. But on the other side, we do a lot of residential, and that is the DSCR products, the non-QM, of course, conventional, regular stuff. But what we're seeing more and more of is the DSCR bank statements, investor, you name it. So there are less restrictions now. I know those terms have just been heard for decades, but there are a lot less restrictions, and we're closing super fast on those. But bottom line, if you have a scenario that isn't cookie cutter, send it. We don't really, like I said, have a minimum, but as long as it makes sense.
I'll call you back after 3. I'm so sorry.
And so we love our brokers. So you're not just part of the business, you are the business. So we're responsive, we're relationship driven, and so we get things done. So looking forward to seeing your scenarios.
Amazing. Thank you, Valerie.
Thank you.
I think we can kind of jump in here. I'll ask some of our panel some questions and you guys can give some feedback and then we'll take some questions or anyone can jump in at any time. A few weeks ago, my partner, Joe Hockey, wrote an article in the Globe Street calling this the Great Hesitation. Great hesitation, buyers, developers, lenders, even tenants hitting pause, not because demand is gone, but because everyone's nervous about interest rates, tariffs, policies, etc. But crucially, hesitating doesn't mean canceling. It means holding at a tipping point. So my question is, how, as you as lenders, identifying deals we're taking through the fog? Like, how are you identifying which deals you want to take? We'll go ahead and start with Gina. You're up in the left-hand corner.
Well, I think that's a fantastic question to bring forward and to allow everyone to talk about. And I have a feeling we're all going to be somewhat similar because, the market was super busy right in and around COVID because rates were low. I mean, it really had nothing to do with COVID. It just more had to do with the resulting rates that came, during that time and through that. And since then, a lot of the borrowers have been sitting on the fence because they're hearing from their experts that rates are going to drop next month, next 6 months. Well, now we are, 2.5 years later, and if anything, rates might have bounced around 5 basis points up or down, but we haven't really seen the drop. When we started this year in January, the premise was that we might even see 75 basis points in the treasuries throughout 2025. Now we're looking at maybe 25 basis points in fourth quarter. So the borrowers and the property owners and the people that are getting ready to buy are just back and forth and all over the place. And we've seen people wanting to wait, but then feeling forced because now their rates have adjusted to, market, which is higher than what they started at 5 years ago. So this is a very long answer, but it's more just giving color to the market. It's a lot of educating, and I feel like a broken record because I do say this at a lot of events, but now more than ever, especially in the last year or so, I find myself educating not only the borrowers, but also the brokers who are our middle guy, the one that we have to trust to educate the borrowers on how the interest rates are affecting the loan amounts that they need. And if in 2021 they were able to, or 2020 or in 2019, they were able to buy the property with 30% down, and now they owe more than the rent support based on today's interest rates, it is hard. So there's a lot of educating, a lot of transparency from the gate to where I didn't have to do that 5, 7, 10 years ago. I do need to be transparent. Here's my numbers. If it gets better at appraisal, great. But the last thing I want to do is, promise a much higher loan amount than I know the appraisal is going to support, than I know the property supports. So that's my long answer. It's a lot of educating. We are still trying to pull the deals off the street. We are busy. I forget who said it earlier. We're still busy quoting and reviewing deals. It's getting the deals to stick is a hard one because borrowers need cash for renovations and rents aren't supporting it. The looming rent controls certainly aren't helping. But Lindsay can attest, and my other apartment lenders, Fred too, everybody online, there's deals to be had. It's just getting them to the finish line that is tricky. And education is kind of the only way that, if somebody's got a better way, I'd love to stop talking so much and start acting. But I think teaching has been kind of the best avenue.
Brad or?
Well, I can touch on that too. I agree with you, Gina. Those are really good comments. When we look at a deal, and I'm very busy, and I look at deals all day long, but the majority of them, there's not a clear path to executing on the loan. So at Axos Bank, in the past, we've looked at
I'm on a conference call.
the collateral. We've been more collateral reliant.
Sorry.
And as of recent, we are more guarantor reliant. So when I hear of a deal, I obviously want to make sure it's in a good location, it's stabilized. Even if it's not stabilized, it just has to be in a strong area, strong market, minimum population of 100,000. But after that, after we get past that initial hurdle, then I'm focusing on the guarantor. How does their global cash flow look? Do they have good global cash flow? And it really boils down to not so much the net worth, their net worth, because everybody, it seems they have good net worth, but it's the liquidity. So I dial in on the liquidity. How much do they have in checking, savings, securities, retirement? Because right now it's very uncertain. We're not exactly sure what's going to happen, and it's like any other time because I've been doing this for almost 4 decades. So but it's more accentuated, it seems now. So we want to make sure that they have enough money, that the guarantor has enough money to carry any deficiency. If there's a deficiency on servicing a loan, we want to make sure that they have that liquidity in place. And that's when I know we have a possible deal. Even though, again, we might be dealing with a property that is a new build and has no trailing numbers, or it could be a value add play where on in-place rents, you could be at a 0.5 or 0.2. So do they have the wherewithal to carry the property? And there's other things that we can do to structure around that with holdbacks and taking additional collateral. But once we know once I know we have a good guarantor with good liquidity, usually that's a possible deal.
Great. Lindsay, did you want to jump in on that at all?
Yeah, I was gonna say I think the hesitation's obviously on both sides, and it seems to be, I know this has been said more than once on the call, it's a lot of looking at deals. I think it's a lot of looking at deals and re-looking at deals. And the runway from like when you start to maybe look at a deal to when it maybe actually comes in, I mean, it could be months. So you might be revisiting it throughout the year, reevaluating it, rates are different. Where are we at now? Kind of re-looking at it. I found that a lot of the borrowers aren't really moving forward unless there's an immediate need to. So they might be interested in a potential refinance or doing something, but unless they absolutely need that, if it's a cash out or if they need that money for something, they seem to kind of put it off. And I think a lot of that has to do with the uncertainty, like you said, in the market and maybe what could happen with rates and the idea that maybe things improve and they're waiting to see. So I think a lot of us are seeing very similar circumstances.
Right. I mean, I think we're seeing about 900 and I think it's $57,000 billion coming due in loans this year, right? So we're going to have to get creative with those. Are they going to be doing cash out? Are they going to refi them? What are these borrowers doing? But maybe moving in a little direction for AJ here, shifting our focus to the small loan agency lenders. Are you seeing a shift in volume for small loan balance deals? Like have the borrower profiles changed? Maybe some more first-time investors or cash out refis, or maybe some mom and pops leaning into the agency programs?
Thanks very much for that, Arcie. So we are seeing a lot of investors who are sitting on dry powder start to delve into the agency program, specifically as maybe their lender of choice has dried up, or as we have some folks who are used to dealing with smaller lenders who may be running into liquidity issues. So we get sponsors that have decided, well, maybe now's the time to jump to non-recourse and go with a lender that can work with me or kind of follow me across the country. That part I am seeing now. The thing about it that's interesting, and I do want to kind of tie back to something that Gina said that's really, really critical, because I'm seeing moms and pops, or because I'm seeing sponsors who stepped away from agencies for a while because banks ruled for 3 years and were throwing out 2.5% interest rates and kicking my teeth in by 90 basis points. Back during COVID when like interest rates were 1 3/4. It was a little hyperbolic, but you get what I'm saying. I find that education is critical. So getting granular Showing a borrower, this is your interest rate. This is what comprises your interest rate. This is how to track when interest rates are going up or down. Sponsors on the phone. If you have an iPhone, go to your stocks app, open up the 1 year, 5 year, and 10-year treasury, track them, because as those yields move, bond yields move, rates will tend to follow. I'll break down cash flow, where a sponsor may come to me, and as we find folks getting more aggressive, as rates have widened some, and you've got folks who are trying to refinance a 3% coupon, take a little bit of cash out, and now all of a sudden they're dealing with a 5.5 rate. They try to get skinny on their expenses. So letting them understand, this is how your deal will be underwritten. This is the underwriting standard that we have to get to. As we have more first-time investors, folks who have more dry powder kind of coming out, at the end of the day, it requires a little more care and attention. That does require more time. So there have been some 12 and 13-hour days that have kind of run the day for me, online till 9 or 10 o'clock, ripping through deals that I think might have a shot, or at the very least, connecting the dots for sponsors to let them know maybe the deal they brought to me, if they're hunting or they're looking for a property that they want to trade into, why this deal doesn't work, but how another might, is something that really sets the table for future business. And there's a ton of it to be had. I won't lie. I'm a very, very busy guy. I probably get 15 to 25 calls a day. And most of my time on each of those calls with the new folks is spent just qualifying and educating.
Yeah, I'm doing a lot of education as well myself.
Yep.
Thank you, AJ, for spreading some light on that. Valerie, okay, so this is just a comment to the room, but surveys show about 41% of lenders see multifamily as the most attractive sector right now. So you're in a great room to be in, right? Despite everything against the rates, what's fueling your optimism, and where do you see you're still cautious, Valerie? What are you seeing? What do you think?
Thank you, Arcie. Yeah, multifamily is still great, although even as developers and investors, we're sitting on the sidelines ourselves as just purchasing, especially in California, just cap rates and rates going up and it not making sense on the ROI or NOI or cash flow. But let's be honest, the market has been a roller coaster over the past year or so, and we've seen deals tighten up, interest rate hikes, and then regional banks pulling back, but they're still lending. So it just takes more thought and more creativity. Like, all of you have said, Gina, AJ, and Fred. And so, even the banks, I know you guys don't need depository relationships, but some of our banks do. And of course, like, just definitely putting the right team together. But multifamily is still huge. Again, rent roll, P&L. And then if the appraisal lines up, then we're good to go. And then, yeah, if the skinny expenses are there, just because you think you could save on that, that's fine. But we're still going to use, 5%. And then, 25% expenses. And then in some cases more. But I saw 3 today. It's a great deal. The only problem that everyone wants to put less down. They just want to put less down, and that's just not an option. And sometimes even if it debt services, guidelines are guidelines.
Thank you. All right, that's great. So I'm gonna go to the people that are in the room and just ask the lenders on the panel, what would be your best advice? In maybe there's some first-time brokers here and they're bringing in their first-time multifamily deal. What's one thing that you'd want them to get right from the start before they even bring you the package?
Can I jump in on this one?
Sure.
Debt service coverage. Learn how to calculate debt service coverage. LTV is awesome, and I can go to 80% LTV. And if you take a look at my program sheet, it's going to tell you that I can get up to 80% LTV, which is awesome. However, if you don't understand the cash flow of the property and how debt service coverage constrains proceeds, what you're going to find is that you'll be over promising to your clients. That's something that you want to avoid. If any of you on the call, I have some Excel tools I'm happy to share. It can help you do a hasty debt service coverage calc. So, and I'm more than happy to spec the time and teach you how to use them. It'll just help you educate your clients a little bit and actually give them something they can see and figure out LTV and DSC.
Well said, AJ. Absolutely. If we can teach all the brokers again or a refresher on how to understand debt cover rather than loan to value. Because, when you get that email where they're like, what's the max loan to value? And I think, oh, I got to get on the phone and explain because loan to value is smoke and mirrors right now.
That's so true. So true. I find that it's very helpful if brokers know their deals. And so when they present the deal to me, I like to know that they know the deal. And so it's really important for them to dig and ask a lot of questions of the sponsor. And that could be anywhere from, vacancies, property related issues, to vacancies, to anything else, environmental issues, credit-related issues, reputational risks. You just got to really have a good understanding of your deal, and it will help because if you just if you try to submit a deal and you don't know, and you're providing information off the top of your head, lenders in general are taking that as gospel initially to issue a term sheet or a letter of interest. But during the process, if you deviate from that information for any reason, for just you didn't ask or it was inaccurate, then that will be a cause of concern for most underwriters, and then you'll be hit hard through a possible increase in rate or a lowering of a loan amount or a possible denial. So having a clear understanding of that deal is imperative.
Yeah, super well said. If I can go for a moment, Arcie, I want to explain something. Do we have a minute or two for me to ramble?
Yeah, I love that.
Okay. For those that are on the call, now I'm kind of a unique hybrid because we're all commercial lenders, but I do a lot of teaching for single family brokers because they want to cast a bigger net, right? So I try to help them come in basically blind, not understanding commercial, and I like to teach them, okay, well, it's a deal if you can get it. So forgive me if I'm talking a little primitive because I believe we have a lot of commercial brokers and a lot of commercial investors online, but Fred raised a really good point. AJ, we're all talking debt cover. If we're talking about multifamily and maybe Fred and Lindsay and even Valerie maybe can chime in, on the apartment sector, for years and years and years, I would use 35% of gross rents as an initial rule of thumb to give me a concept of where appraisal market expenses would fall. I'm finding with the last couple of years of insurance premiums increase that I'm leaning more on 38, 39% to kind of initially scrub the numbers. And the reason I bring this up, and I'd love to hear when I'm done rambling what Lindsay and Fred are kind of using. Are you increasing those? But ultimately, you want to get to your net operating income to discover what your debt coverage ratio is. And I have to teach because I've got a lot of residential guys coming in. But if you've got a commercial background, take your gross rents, use your buffer of expenses before you spend your borrower's money on the appraisal. Figure if it's 35 or 38%, kind of all encompassing your taxes, your insurance, your property management, landscaping, etc. Most of us use 5% vacancy factor. So gross rents minus expenses minus 5% vacancy gives us a net operating income. That net operating income has to be 20% higher than the annual mortgage payments to meet a 1.2 debt coverage ratio. Anybody chime in and let me know if I'm wrong, but that's a quick and dirty way to get there. And then, like AJ said, he's got worksheets. I think all of us have worksheets because I don't like to run numbers all day long. I like to plug them in and see if they work. And so reach out to AJ, reach out to me, reach out to any of us for the worksheets because then you just show your client, here's your in-place rents. Here's what we think expenses are going to be before we get the appraisal. If expenses come in higher, loan amount goes down. Expenses come in lower, loan amount goes up. It is pretty simple. It's just teaching on how to get those numbers, right? Anybody have anything to say to that?
You're right on the money. You're right on the money. The only thing that I'd recommend. So one of the things I do, 30 to 835 was like the solid way to be. Little things that I do in my head when I run a cash flow. The first thing that I'm going to do, I'm going to calc the taxes now. I'm going to either pull the tax bill. I'm going to look the asset up in CoStar. I'm going to take a look at my assessed value, my loan amount, whichever one's higher. Apply the millage to either the loan amount or to the assessed value and make sure that my underwritten taxes are solid. For insurance, I find that it's coming in at about $800 a door on a national average. That is a terrifying number, by the way. The baseline when I first started doing this 100,000 years ago was about $150 a door. So it's been an exponential increase. And this 800 a door is double what it was 2 years ago. So 800 a door for utilities. Water and sewer tend to be the heaviest. I'm going to think about somewhere between 900 and 1,300 bucks a door, depending on municipality. For R&M, think about 750 as the absolute bare bones bottom combined repairs and maintenance figure. The skinniest I've ever seen it in an appraisal is 700 bucks a unit. For management, I will generally assume 4%, though in the real world it probably tends to be 5 to 7. For G&A, I will assume 1% of EGI for general and administrative cost, and for reserves, $250 a door. If you go through each of your expense categories and got to figure that out, that's going to walk you right to Gina's, about 38% based on where the truth on the ground is today.
See, got any feedback there?
I say two things to point out would be insurance can vary so drastically. And that has to do a lot with the property, the utilities, the age. It's kind of a huge X factor, really. So I would say that is one of the first things that we start on here, and it's usually the last thing to get done. And we sometimes are waiting on it to get docs out, or to get the loan approved. So things can evolve and change based on the requirements of the lender, and what's in place. And so I would caution, if you're looking at, purchasing something that might, to look into that up front, maybe try to get a quote from your carrier to see where it is, because it can vary, very extremely. And then I guess on the expense load, one thing to caution is that expense ratio really varies based on, the rents, are they at market? Are they close to market? Are they well below market? So, and if you're looking at something that the rents are well below market, then your expense load is going to be higher, and you can expect to have, a lower leverage for that type of property. But I think I echo everyone with the information and how well put together the information is up front makes it easier, and kind of asking those questions. I have found that I feel like the packages received aren't like the quality that they used to be. And I don't know if some of that has to do with maybe the borrowers aren't as interested in, they're not in a hurry. There's no sense of urgency. So maybe they're not answering all those detailed questions that you really need to fine tune to get, the most accurate historical information to be able to provide an accurate loan amount. So, I don't know if that has to do with really the borrower sentiment and how interested people are in kind of moving forward quickly. I don't know if others have seen that as well, but.
Yeah. Yeah, that's well said, Lindsay. A lot of people tend to go on vacation right after they sign an LOI. Why now? Let's start it later. For those that are online that are newer to commercial or need a refresher, not that I'm trying to plug anything, but I'm doing a free class on Tuesday through Zoom. If you're new to debt coverage ratio, just message me and I'll get you the link. It's just free. It's like an hour just to help extend the education, right?
Yeah, Gina, that actually really leads me into probably my last question before I open it up to everyone chiming in on a lot of your great information. But if we have some new investors, some new borrowers sitting on the call, who is sitting on the sidelines waiting, when's the right time? When's the perfect time to transact? What it would be your best advice to our new investors, our new borrowers coming in? I know it's a tough question right now.
That's a hard one. I mean, my son was trying to buy a house 3 years ago, and I told him to wait, and then rates went up 2 basis points. Like, I don't know if anybody here has that beautiful magic 8 ball, right?
The magic wand.
Yeah.
If,
I've
if
been,
I, go ahead, Fred.
no, AJ, go ahead, please.
Oh, I was gonna say if I understood or knew that beyond the shadow of a doubt, I would not be on this call. I'd be on a beach someplace, sipping a Mai Tai on a giant pile of money.
We just got to say, jump in and do it, right? I mean, there's
The
never
best deal of your life comes along every day.
just take the dive. Yeah.
I usually tell people that you can't ignore location, location, location. Don't ignore the fundamentals. And stop chasing cap. Stop chasing the highest return. Because again, I'm dating myself because I've been doing this almost 40 years. I've seen people go out into really remote locations and call me up and say, Fred, I got this great rate, a 13% cap. It's fantastic. I'm looking for 80% leverage. And it just doesn't work. And it may be for a very short period of time, but what goes up, I mean, again, you're talking about a very high cap rate. There's in that is risk. And what goes up will come down. And as quickly as that rate, that cap rate has gone up, it can drop. So I usually tell people, don't ignore the fundamentals. Stick with your gut and location, location, location. And that's my advice to them. And over a long period of time, it has proven many. Well, it's done well by them.
Thank you, Fred. So, do we have anyone on the call that would like to jump in and maybe ask one of our panelists a question or two about what we've already been speaking on?
Yes.
Great. No one?
Yes.
Jump
Oh.
in. Let's hear it.
Can anybody hear me?
We can hear you.
Okay. Behind me, right here, it says, you can hardly see it, Parry's Hardware Company Incorporated. My father's hardware store from New Jersey from the 50s and the 60s. That was the original Yellow Pages thing. Kind of funny. Anyway, I do a quick ratio. I put this into the chat that bypasses debt service coverage ratio. I take the gross rents, and then what I do is I subtract the vacancy at 8%, the management at 5%, the expenses ranging anywhere from liberal to conservative at 22 to 27%, which gets me into 35 to 40% all in. The inverse then is either 60 or 65%. That gives me my NOI divided by the cap rate. I get the value in the LTV. That's based on my financial accounting at Harvard and my master's degree in real estate finance at Georgetown. And I've bounced this off of professors who thought it was a really great way to bypass DSCR because the net numbers are the same. Does anybody else use that quick ratio?
Generally, I tend not to use it, and it isn't because it's not a sound methodology to figure out whether or not you have a dog that hunts. I would say that in a stable market or a market that wasn't, for lack of a better term, clinically insane, which is, I think, probably a pretty fair descriptor of where we are now. I like to be exact. And the only reason that I like to be exact is because I've found that a lot of the generalization or quick ratios that I had done in the past to work on deals got me to a spot where I had an accuracy. And when we're in a market where we're debt service coverage constrained, and that when rates move as rapidly as they do, and every single dollar matters, I find that I have sponsors who need to know down to the dollar where they're going to be before they lock. I think the ratio is a great idea. Just something that it has a good place has a place to be in a stable market. I just think right now, because things tend to shift so quickly, the ground could disappear underneath your feet sometimes.
As a conjunctive follow-up, do any of the lenders, in terms of underwriting, use hurdle rates, which is what the investors want on their ROI, related to the internal rate of return that has a net present value of 0 above the weighted average cost of capital, or is that too deep into real estate finance on the academic level and not applicable to the fundamentals of day-to-day underwriting at the lenders?
I can jump in on that as well. I was a CMBS 1.0 guy. I went from there to working at Bricadia, an agency, and went from there to working at Chase. So CMBS 1.0, we had a constant, and that constant changed based on what our rate lock desk wanted it to be. And it was a week-to-week thing based entirely upon the ROI that we were chasing based on securitization pool. Obviously, we're not CMBS 1.0 anymore, but that methodology did have a place at the agencies. The only place where you're going to find a floor rate is going to be on 5-year debt. And that's only because of how immeasurably popular it is right now. So you'll see some constraint there. And at Chase, there was a floor rate for me as well. But now in the agency space, if you're looking at 7 or 10-year money, there is no floor. You write strictly to coupon. And that means that I do lots of recalculation of loan amount day over day until my deals lock.
Got it. Thank you.
No worries.